Hey, time is up. Please hand your quizzes in towards the end of each show. Please hand your quizzes in. Please hand your quizzes in. Time's up. Okay. Um, Usual rules apply. I will grade them, let you know when it's ready to be picked up. And they will be in alphabetical order face down on the 9th floor. I usually don't talk about quizzes right after they're done, but there was a question that came up on 4 that I want to clean up on. You know, do you remember problem 4, right? You have a company. I gave you the financial balance sheet. What does that mean? Basically, I've given you the values of the businesses and debt and equity. What does the company do? It borrows 200 million. Let's pause right there. The minute after you borrow the money, what's going to happen to your balance sheet? You'll have 200 million more in debt, and on your asset side, you're going to have, what do you get when you borrow money? Cash comes to the company, there'll be cash. And then what do? They use the 200 million to buy back stock. Nothing happens on the asset side. When you borrow money, when you buy back stock, by itself, those actions don't affect your assets. It's only when you go out and acquire another firm, divest it, that assets change. So when you have recapitalizations, you're really just changing the mix of debt and equity in your firm. So today we're going to talk about the last piece of the corporate finance puzzle, and it should be the simplest, but unfortunately, I think it's the one where you see the most, I don't want to say irrational, but strange behavior. So when you think about dividends, I want to start with a proposition. I mean, you often hear about statements like Apple has 160 billion in cash, or that Google has 110 billion in cash. Let's be quite clear. Companies do not have cash. They hold shareholders' cash for them. changes your entire perspective of dividends. Rather than you begging the company to return cash, the company should really be begging you to reinvest the cash. But at least in the way it's structured, companies act like it's their cash and they're doing you a favor by returning some of that cash. So in the dividend policy section, I want to focus in on first, how much cash you should return as a business, public or private, to the owners of the business. So if it's a private business, how much can the owner take out of the business? And second, in what form? And there are two basic ways you can return cash as a company. And I'm going to argue that from the company's perspective, the effect is exactly the same. You can either buy back stock or you can pay a special dividend. From the shareholders' perspective, there might be differences and shareholders might like one more than the other. But from the company's perspective, either way, cash leaves the company and you're doing it because you have extra cash. Now, if you, what is it? Why are you done now? The quiz was done 5 minutes ago. Okay, come leave it in the front. So when you think about, dividends, and I defined equity as a residual claim. The definition of a residual claim is you get whatever's left over after every need is met, right? So forget about dividend policy. Think about running your own business. What's the question I'm asking? How much cash can you take out of this business when all is said and done? So as an owner, you're going to say, look, I'm going to start with my earnings, which is not in a cash flow. I'm going to add back the depreciation because it's going to give me a cash flow. Then I'm going to subtract that CapEx, change in working capital. What's left in the till at the end is your potential dividend. We'll talk about how to do that for a publicly traded company. But in a world where cash flows are truly residual, this is how dividends should work. You start with what you earn as a company. I know it's not cash flows, but it's accounting earnings. And then you convert to cash flows by adding depreciation. Then from that, you start to write checks. So think about the old-fashioned checkbook. You write a check off for CapEx because you have to land, building, equipment. Why do you do that? Because you want to grow in the future. If your working capital goes up, that comes out of that. And what's left at the end should be what you pay out as dividends. So if this were a rational world, what should you expect to see when you look at the dividends of a company? Should you expect to see the same number every year? I mean, how can you have the same residual cash flow? Already you can see that in practice, dividends don't get treated as a residual cash flow. It's almost like companies feel the urge to pay what they did last year. And I'm going to argue that that is at the heart of dividend dysfunction because you think you have to pay dividends. So I'm going to talk about the two forces that drive dividend policy. And if they look familiar, it's because they also drove capital structure. One is inertia. Why do you pay the dividends you do? The answer is very simply because that's what we've always done. The fact that you can't afford to pay them anymore seems to be a non-issue. You just continue to pay dividends into bankruptcy. The second is Me Tooism. Why do you pay the dividends you do? Because other companies like yours pay dividends and you don't want to be the odd man out. You're a bank. Every bank pays dividends. You pay dividends too, even though you can't afford it. You're going to see how that plays out and what companies actually do. So let me state some very simple facts about dividend policy, at least as practiced now. You have a century of publicly traded companies in the US. You see what they pay in dividends. This looks from 1988 through 2023 at the percentage of US companies that increase dividends. That's the green part of the chart. The percentage of companies that cut dividends. Let me pause right there. You look across time, even in the worst years of the market, 2008, 2020, what do you see? The number of companies increasing dividends outnumbers the companies that decrease dividends. Strange, right? You're in a crisis, you'd expect the reverse. But in every year, the number of companies that increase and decrease dividends is outnumbered by the number of companies that do nothing. They pay what they did last year. The word I use to describe dividends is as sticky. Once you start paying them, it's really difficult to change them. If you change them, you're more likely to increase them than decrease them. The dividends are sticky. And if you see, this particularly in crisis years. 2020 was a horrifically bad year for companies, right? The global economy shut down. Lots of companies were in trouble. So if you look across the S&P 500, that year, 287 companies increased their dividends and 11 initiated dividends for the first year. in 2020. It is true that the 42 dividend suspensions you saw that year were a record. You usually don't see that even in 2008. But even in that terrible year, you could see that the number of companies increasing dividends outnumbers the companies decreasing dividends. Second, dividends tend to follow earnings. Key word here is follow. They don't lead. They're not contemporaneous. They're going to follow earnings. So you see how this is going to play out, right? Let's say you're a company that pays $1 dividend and you have $4 in earnings. Let's say next year you have a really good year. Your earnings go from $4 to $5. You should not expect to see dividends go up next year because the company likes to wait. 2 years in a row, earnings go up. Maybe in the second year, you'll see dividends go up. But companies seem to wait until they increase dividends. And I want you to start thinking about sticky dividends and how that might play out and why companies are not quick to jump on the bandwagon and increase dividends. So dividends tend to follow earnings. And they are affected by tax laws. Tax laws on whom? On investors who receive these dividends. From 1913, which is, or 1915 maybe, the year that the income tax was introduced in the US, to 2003, dividends were taxed as ordinary income. If you filed your tax returns, you know that income can be ordinary income or it can be capital gains. Dividends were taxed as ordinary income and you were taxed at an ordinary income tax rate. Right now in the US, at the highest tax bracket, that's 37% at the federal level, plus state and local taxes. So in New York, you're probably paying 48% on it. So dividends were taxed at an ordinary tax rate. But if you got capital gains and you held them for a year, and that rule's kind of changed around a bit, you were taxed at a capital gains tax rate, which was much lower than the ordinary tax rate, at least until 2003. At least in 2003, the capital gains tax rate was set at 40% of whatever your ordinary tax rate was. So if your tax rate was 50 on ordinary income, on capital gains, you got 20%. Already you can see as an investor, you'd rather receive capital gains and dividends because you're taxless. What happened in 2003? We got once a decade, the US Congress goes into conniptions, writes a new tax law, says this is the last time we'll rewrite the tax law. It turns out to be a complete lie in hindsight. But in 2003, we had a tax reform act. And what that act did was it brought dividends and capital gains to the same tax rate. They were taxed at the same rate. It was 20%. You're saying what happened in 2008, 2009, with the Obamacare, you had an extra 3.8% added to both those tax rates. But since 2003, the tax rates on dividends and long-term capital gains has been the same. So if you think about taxes being a reason why companies might buy back stock rather than pay dividends, starting in 2003, that reason got less tenable. We'll talk about why you still might prefer capital gains, but you should prefer them less than you did pre-2003. But here to me is the biggest shift in dividends. In 1981, when I first started tracking stocks, hardly anybody bought back stock. Maybe one company out of 500, and usually was driven by some need to reduce the number of shares. Starting in the mid-80s, you can see that buybacks are starting to pick up. So basically each year, the red is the buyback. So this is, I started in the late 80s. In 1988, twice as much cash was still returned in dividends and buybacks. But over time, if you look at that percentage, even with blips, the trend line is obvious. Increasingly, US companies are returning cash to their shareholders in the form of buybacks instead of dividends. You can't contest it. This is a fact. So I have a question for you. What is it that you think has changed over the last 4 decades that has shifted companies away from dividends to buybacks? And as you think of the reason, remember, if it's a reason that pre-existed the mid-80s, then it can't be the reason. So it's got to be something that started happening in the mid-80s that explains the shift to buybacks. Any ideas why companies might have? No? Praga?
I think maybe they're less worried about raising new equity.
They're less worried about raising new equity.
They're buying back as opposed to paying dividends for more flexibility.
No, but let's say they're less worried about issuing new equity parts. So what does that mean? That they're so pre-1980s, they could not issue equity, and now they're thinking they can issue new equity? It's become easier? What is it that's changed?
buyback more, they do need it in the future.
So you think access to capital markets is improved, at least for large sets of companies, so if they pay too much, they can issue shares. Now, let me play devil's advocate with each of these reasons. The cost of issuing equity has not changed very much over time, so it's still as expensive. Yes?
Look at 08, 09, and 2020, market's down, buybacks is down, basically they're buying back their price.
Was it just share prices that were down in 2020? The companies, what happened to companies' earnings and cash flows? Oh, they were devastated. In fact, they went down even more than, so in the bad years, no. So, but weren't there bad years pre-1983? So if you're saying dividends give you the flexibility to reduce cash return in bad years, why wasn't that the case pre-1988? And why has it become more critical over time? Yes. It actually just long-term capital gains has always been 20%. So what happened in 1986 is the ordinary tax rate came down to 28%. Right? So in fact, the benefits to getting buybacks has actually decreased since in the 60s. The highest marginal income tax rate was 70%. The capital gains rate was 28%. So if anything, you should be seeing fewer buybacks now than before because the tax advantage has shrunk. And essentially it's disappeared since 2000. Justin? Okay, so that is one reason. Did everybody get Justin's point, which is if executives get compensated with options, there's a reason you want to buy back stock, right? Because what happens when you pay a dividend to the stock price? It has to go down. It's the ex-dividend day. It's not good or bad. The stock price, we'll talk about how much it'll go down. If instead you return the cash in the form of buybacks, you don't get that dividend drop, and you might even get an increase in the stock price if there's a demand supply issue. You basically have reduced the share count. How would you test that proposition to see if that was the main reason for it happening? If that was the main reason, and I gave you all US companies, and I gave you the data going back to the 80s, how would you test the proposition that it's management compensation that's driving the buybacks? What kinds of companies should be buying back more then? Companies where you compensated employee managers with more options, right? I actually broke down all US companies by option. You can get it on Capital IQ stock-based compensation, and there's very little correlation. So if it was a reason, it was maybe an early reason. And remember, even companies that compensate their employees with stock have turned from options to restricted stock. So starting in 2007 or 8, when that happened, you should see buybacks go down. So it's true managers have self-interest that might lead them to it. So it's not taxes. Management compensation is only part of the story. Yes. They've never been illegal in the US. They were illegal in Europe for a long time because your book equity could not turn below 0. And some countries actually barred it. In the US, they've never been illegal. So you've always been able to buy back stock. Yes, Brad.
I guess in 1988 and now, how the spread between cost of equity versus cost of debt changed?
Easy to find, right? I gave you, remember the graph I showed you of equity risk premiums versus default spreads? But remember that if will just change how much cash you return. It shouldn't change whether you return it in dividends or buybacks, because either way you return cash to the company. Clear? It's a differential. So 1981, Ronald Reagan lowered the highest marginal tax rate from 70 to 50%. And the capital gains tax rate was 40% of that. So that's always, so it dropped from 28 to 20%. So basically it moved the entire schedule down. And if anything, it reduced the potential benefits of capital gains, because if you think about the difference, pre-Reaganomics, it was 70 minus 28. After it's 50 minus 20. By the time you get to 86, it's 28 minus versus 20. And in 2003, it becomes 20 on both. So if there's a trend line here on taxes, it's that dividends are being taxed less than they used to be rather than more. It's all pushing in the opposite direction, right? Let's take the flexibility issue. Does everybody agree that, dividends are more flexible? I'm sorry, buybacks are more flexible than dividends. What is it about dividends that makes them inflexible? I've kind of gave away the game when I first described dividends as sticky. What does that mean? You pay dividends, you feel the urge to continue paying them. In 2020, any sensible company, if you're a hotel company, what the heck are you doing paying dividends, right? But if you're trapped in that dividend cycle, it's very difficult to step away. That's always been the case. Buybacks have always been more flexible. So we have to tell a story that explains why the need for flexibility has increased from the 1970s today. Why do you think companies feel the need to be more flexible now in terms of cash return? Claire? Globalization. Let's take that. Let's play it out in terms of earnings. If you go to 1970, each country had companies. The companies dominated the local market. They didn't worry about competition. GM and Ford, until the Japanese came along, owned the US auto market. What did globalization do? It took those nice, secure markets and opened them up to competition. So the first is globalization. Globalization has made companies around the world, it might have made them prosper collectively, but it's made their earnings less secure. You're never sure where the next thread is going to come from. Yeah, that's one of them. What else? Go ahead, Claire. Yeah, good.
Maybe the impact of stagflation in the 80s. They wanted that flexibility.
It was 70s actually, because by the 80s you'd solve the problem. So if this had started in the 70s, you could say maybe it's inflation, but by 88 inflation was out of the picture. Yes. Okay, let's stop in there. So do you think the investor base might have changed as well, right? The old time investors bought the stock, they collected the dividend, they didn't even check the stock price. Maybe investors care more about prices now than they used to, institutional as well as individual. So the CEO tenure is more of a distraction than anything else. If investors care about it, you're going to try to deliver it. Maybe that's part of it. Yeah. The 401k Act, pension funds, actually pre-401k, companies used to offer pension funds. So basically the 401k basically brought more investors in the market. And in the 401k, you're actually fine with dividends because dividends and capital gains don't get taxed, right? It accumulates in your 401k. What about the word disruption? What does that tell you about predictability of earnings? What does that mean? You take a status quo business that felt pretty secure, brick and mortar retail in the 90s, right? They had a nice business, you had to come into a store to buy things. What did .com and online retail do? It disrupted the business. I've never understood when disruption became a good word. Because I remember when I was 7 years old, there was a disruptor in my classroom. You know what they did to him? They made him sit in the corner, look in the corner, put a white dunce cap. Actually, they made a white dunce cap. You're saying, this is child abuse. Our reaction was, thank God it's not me. That same kid at 10 was in the principal's office, right? Disruptors through time have essentially been ejected. But somewhere in the last 15 years, disruption became this glorious word. Silicon Valley started companies. We're disruptors. Go sit in the corner, look in the corner, put a dunce cap on. Because itself, disruption is neither good nor bad, but the essence of disruption is it takes the status quo and shakes it up. Companies get less secure about the future. There's a reason why we're seeing a shift away. To be quite honest, dividends have never made sense as a way of returning cash to shareholders because it's a fixed number. And if this is residual, you should be adjusting how much you return. You could actually argue that dividends are the problem, not buybacks, because buybacks allow companies to adjust. I'll give you the story that I think best explains the shift to buybacks. My daughter's almost 30, and every day she wakes up and she thinks this is the end of the world. She's going to get middle-aged. To her, there's no coming back from that. But I remember when she was 8 years old, driving her to a birthday party. She was still so light, she had to be in a car seat. And she's an imperious little person. So she gets in the car, she demands that I turn the radio to Z101, it's her favorite radio station. And I think they play the same song over and over and over again all day long. And they mention the name of the singer, I have no idea who it is. And then between the songs, there's this talk between the DJs. So they start talking about hooking up. To show you what happens after 20 years of marriage, I didn't even know what they were talking about. And then my 8-year-old from the back seat starts to explain in a very convoluted way what hooking up is. Part of me is in shock that my 8-year-old is telling me this. The other part of me says, this is a great way to explain the shift from dividends to buybacks. Dividends are like getting married. Remember the rest of the out through good times and bad times for the rest of your life, right? Buybacks are like hooking up. Nice knowing you. I don't know your name. Let's move on, right? Companies and investors, both sides, have no desire to get married, get connected for the long term. And guess what? We reap what we sow. This trend is not just in the US, it is global. So next time you're a politician, US companies are doing it. This is happening across the globe. In 2023, these are the buybacks, and you can see buybacks as a percentage. Africa and the Middle East has the lowest percentage, 7% of cash return. The US is the highest, 57%. But the UK is up there, Japan is up there. So you're going to see some surprising entry, and it doesn't surprise me. This to me is an inexorable trend, no matter what politicians do and what the tax law does. Politicians, for some reason, think of buybacks as evil, that somehow this should be stopped. And if you remember, last year's tax package actually had a specific provision of the tax law directed at companies buying back stock. So any questions on the trend lines? Dividends are sticky, dividends follow earnings, dividends are affected by tax laws, and dividends increasingly are being supplanted by buybacks. Last year, almost 70% of the cash returned by US companies took the form of buybacks. This year, I wouldn't be surprised if that number became 75%. Will buybacks ever be 100%? I don't think so. But the trend is going to be pushing up buybacks. Claire? Well, the recession in 1981 was a US recession, right? So basically, I think that, I don't think that by itself changed. It was an inflation break, so there was a change in the economy. That by itself didn't trigger the buybacks. Along the way, Congress, in its usual way, tried to stop buybacks. And you know how they tried to stop buybacks? They tried to put a cap on management compensation, that it could not exceed $1 million or whatever it was, 5 million, and you lost that. But when they wrote it in 91, nobody thought about options as part of compensation packages. So they wrote the law in terms of compensation. If it exceeds 5 million, you lose the tax benefits, but they forgot to put in options as part. So guess what happened in the 90s? Companies increasingly turned to options because it gave them a way of getting around the law. So let's talk about how much companies return and how you would gauge whether your company is returning a lot, returning average, or returning less. Dollar dividends don't work, right? Bigger companies are obviously going to return more cash. Apple has bought back $500 billion of stock in the last decade. 500 billion. This is the amazing thing about Apple. Usually when you return 500 billion to your investors, cash leaves the company should get smaller, right? While they're returning 500 billion, their market cap went from $1 trillion to $2 trillion. That's why I call Apple the greatest cash machine in history. They can't return cash fast enough. So if you're looking at your company and say, how do I decide how much my company is returning? Let's focus just on dividends first, and then we'll talk about how to bring buybacks in. There are two measures that people use to gauge how much a company returns as dividends. One is to scale dividends to net income. That's called the payout ratio. You're saying, what if my net income is negative? Your payout ratio becomes not meaningful. But if you have $100 million in net income, you return $40 million to your shareholders, your payout ratio is 40%. What does it measure? It measures the percentage of income you return, and the inverse of the payout ratio measures how much you put back. It's called the retention ratio. So the payout ratio plus the retention ratio works out to 100%. That measures how much you're returning relative to net income. You can also divide dividends by the stock price. When you do that, you get the dividend yield. What does that measure? It measures the portion of your expected return that's going to come from dividends. I'm going to take you all the way back to session 6 or 7, where I used the risk-free rate plus beta times risk premium to come up with an expected return for Disney. Remember that 9.5%? So if you're a stockholder buying Disney, I said that's the return you can expect to make. That return can come in two forms. Some of it is going to come in the form of dividends. The rest will come from price appreciation. So it's good to get perspective. So let's say you took a company and you divided the dividends by the net income. You have a payout ratio, right? You can look and say, is that low? Is that high? Some of you, in fact, many of you might see a 0 payout ratio. Google pays no dividends. This thing is that common. Let's see what payout ratios look like, both globally and the US. And basically, I've computed both the payout ratio and what I call the cash payout ratio. The cash payout includes buybacks as well. So basically, it has more cash. So you see the distribution. If you wanted to pick a middle, it's around 30 to 40%. So if your company is returning 70 or 80% of its income, it's returning more than the typical company. If it's returning 10%, it's returning less. But here's a nice trick question to ask. The next time, so you're on the other side, you're interviewing people for an internship or a job, you have the power, right? Ask them what the median dividend payout ratio for a US company is. What's the answer? 52.6% of companies globally don't pay dividends. What's the definition of median? It's a 50th percentile. The median company globally pays no dividends. It's even worse in the US. 60% of US companies don't pay dividends. The median payout ratio is 0%. So I'm trying to give you comfort. When you get that 0 payout ratio, I know you're going to email me and say, do I have to change companies? My company does not pay dividends. Not paying dividends is a dividend policy. You'll have to explain to me whether it makes sense, but you are actually the rule. The people who have the dividends are the exception. So think of that when you think about payout ratios. If you look at dividend yields, the median dividend yield is about 1.5 to 2% globally. It's a little less in the US. So what does that tell you? When you buy shares, if dividends are your only way of getting returns, you've lost the script. Without the price appreciation, you're not going to make your money on stocks. That median dividend yield has decreased over time. Why? Because buybacks have supply. With buybacks, you're closer to 4 or 5%, but the dividend yield is about 5%. Now, with both these charts, there are companies you look and say, what are those companies doing? Let me go back to the payout ratio chart. So there are companies with payout ratio 10 to 100%. And then you have a lot of companies that pay out more than 100% of their earnings in dividends. Sounds insane, right? Some of them might be insane, but tell me good reasons why companies might pay out more than 100% of their earnings as dividends in any given year. Justin? One is, if you're a real estate investment trust, by law, you're required to pay 95% of your earnings. You're very quickly going to hit 100 and go through. Mladen? Because in any given year, you can use previous year's cash balances. So the second might be you're paying dividends because you've accumulated cash from previous years. You better be careful that you don't lock yourself into a dividend policy where that cash runs out. Let me give you a third possibility. Cyclical and commodity companies. Why might they pay out more than 100% of their earnings as dividends in any given year? Mladen? But that's not a good reason, right? You're going to get trapped. But what happens? The earnings of cyclical. Take ExxonMobil, mature oil company, right? Take a look at its earnings over time. Nice stable number? No, it's going to go up and down, often 30, 40, 50%. Why? Oil prices go up and down. Commodity and cyclical companies have that cycle. So what they often do is pay dividends through a cycle. What that will mean is your dividend payout ratio will be 130% in a bad year. It'll drop to 50% a good year. Over the entire cycle, you might pay out 60% of your earnings, but you're going to see that. So that's a third possibility. Any other reasons why a company? Remember the life cycle that we talked about? What happens in that last stage in the life cycle? Your business is getting worse and worse and worse. What should you do? Just go away. How do you go away? You partially liquidate yourself. It's called a liquidating dividend. You pay out more than your earnings. You do it deliberately because you think that's terrible. Don't you wish Bed Bath and Beyond had started liquidating dividends about 7 years ago? And that GE had liquidating dividends starting in 2010? Again, this notion that paying dividends is a failure, it's a sign that you've given up, is absurd, because there are times when you should give up, right? Your business is no longer there. If I ran an airline, you know what I'd do? I'd pay liquidating dividends and liquidate myself in 2 years. Why would anybody want to be in this godforsaken business? So when you look at companies paying out more than 100%, and one of your companies happens to be one of them, look across time. It could be a cyclical or commodity company. It could be a company with a lot of cash balances, or it could be a company in the declining phase in its life cycle. On the dividend yield, there's a group that is a little interesting. What's the T-bond rate right now? About 4%, now 4.5%, approaching 5%. Notice the companies which have dividend yields of 7, 8, 8.5. This sounds too good to be true, right? It'd be a Ben Graham chapter 1. It's a slam dunk. You buy the stock, you collect an 8% dividend, and you get price appreciation. And isn't that the heart of old time value investing? You want to buy a bond with price appreciation. And if you believe old time value investing, you're going to be buying stocks in this end. What's the danger of doing that? It is higher than the T-bond rate right now. But what's the difference? T-bonds give you a contractual claim, right? So when I say 4.5%, even a corporate bond gives you a contractual claim. A dividend is not a contractual claim. Right now, you might pay 8% of your price as a dividend yield. Next year, you might pay me nothing. If you can sustain the dividends, it's amazing. But most of those companies you will see in the very high dividend yield are basket case companies. You would not want to buy them because the price is down for a reason. So think back to the life cycle, because it's going to give us a framework for thinking about dividends. Early in the life cycle, you're losing money, you have big negative cash flows. Of course, you shouldn't pay dividends or buy back stock. As you mature as a company, your earnings might turn positive, but your cash flows are still negative, still not time to return cash. You become a growth company, your cash flows turn positive, you might still hold back. Why? Because you're uncertain as to whether growth will come back. But then as you approach maturity and your cash flows and earnings become more predictable, you should expect to see companies return more cash. And if they fight returning cash, what should you see at these companies? So let's say your company is now mature, it should return $5 billion in cash every year. It's choosing not to do so. Why? Because it thinks it's a growth company still. What will you see in this company that gives it away? You have $5 billion to return, you don't return it. Where does it show up in your company? Don't say return earnings, wrong side of the balance sheet. I want you to think on the other side. You have $5 billion in cash, you chose not to return it. It's going to show up as an increase in your cash balance. And every year you do this, what will happen? Your cash balance will get bigger and bigger and bigger. When you see Google's $110 billion and you ask Google CFO, have you been returning enough of your money to your shareholders? You know what the CEO is going to say? Of course. He lies with a straight face. Of course you're not. How else did you end up with $110 billion in cash on your balance sheet? So as you look across companies, you should expect that. So it's a very simple starting point. I looked at dividend yields and payout ratios by expected growth in earnings. So I broke companies down. Remember, we go to Capital IQ, I can get the expected growth in earnings. No surprise here. The higher earnings growth you have as a company, the less cash you should return, both as a percentage of net income. In fact, if you look at the highest growth companies, the median payout ratio is 15%. A big chunk of those companies will not be paying dividends at all. So for my companies, here's what I have as my dividend yield and payout ratio. I've computed the last 12 months, which is the 2013 numbers. But just to give you a perspective, I also have a 5-year average. So you look at Disney, 1.09% dividend yield, 22% payout ratio. Looks very similar to what it was in the last 5 years. We can come back and ask, are they returning enough cash? But this is what they're returning. If you look at Vale, 6.56% dividend yield, 130. You see, this is amazing. I'm going to buy Vale. But before you do that, if you look at their history, it's clear that they're having a bad year. They're choosing to return more than they can. You look at Tata Motors, very similar to Disney. What they return is low, and what they've returned in the past is also low. Baidu, that was an easy dividend analysis. And some of you, this is what you're going to see, zeros. You're saying, what the heck do I do? don't give up yet. Don't write that section and say, my company does not have a dividend policy, so skip this section. Your company is not paying dividends. You need to explain to me whether that makes sense or not. And finally, you look at Deutsche Bank, and this is the definition of insanity, right? You have a dividend yield of 1.96%. Your payout ratio is 362%. You say, maybe earnings will bounce back. In what universe is that going to happen? Deutsche dug a hole for itself. By 2016, it had cut dividends, but it waited too late because every time you pay dividends, it comes out of your regulatory capital. It was a self-inflicted wound that was completely avoidable. So take a look at your company, see what it does, because that is the starting point for your dividend analysis. So I'm going to look at 3 schools of thought on dividends. The first school of thought says dividends don't matter. You can pay high dividends, low dividends, your value as a business and what investors get as a return should be untouched. Does it sound a little familiar? Earlier in this class, there was something else that did not matter, right? Your capital structure did not matter. That was Miller-Modigliani 2 or Miller-Modigliani 1. This is Miller-Modigliani 3. In the Miller-Modigliani world, we could have stopped this class after capital budgeting. But I'm going to start there because it's actually a good starting point for thinking, when do dividends not matter much? We'll start with the dividends don't matter school. The second school of thought argues that dividends are bad. And this school, especially coming through 2003, had a very strong argument to make. They said dividends are bad because when you as a shareholder receive dividends, you pay a much higher tax rate than you do on capital gains. So why are companies paying dividends? They should cut dividends to 0. We'll talk about the flaws in the logic there, but you can see the logic. And to complete the process, there's a third school of thought that says dividends are good. Why? Because there are some investors out there who like dividends. So I want you to start thinking about what kinds of investors like dividends, even between individual and institutional investors. And if your clientele, your investor base includes those investors, paying them more in dividends is actually going to push up your price. This is very convenient if you're a CFO, right? No matter what you do, you got an entire school of thought backing you up. If you increase dividends, you point to the dividends are good school. You cut dividends, the dividends are bad school. If you have no idea what you're doing with dividends, you fall back on Miller-Modigliani. So let's start with the arguments here, but I'm going to tell you where I'm going to end up. I think there is some truth to all 3 schools of thought. I'm going to steal from each one, but in my composite view, I'm going to argue that if a company has lots of cash and not very much to invest in, it should try to return the cash to the shareholders. Everybody agree? So it really becomes, how do we measure cash and what are the opportunities? Conversely, if you're a company with lots of opportunities and not that much cash, what the heck are you doing returning cash to shareholders? So in the dividends don't matter school, the Miller-Modigliani school, let's think about what happens to companies when they pay too much in dividends. So play the role of a company. You can afford to pay out 100, you pay out 250 million. How does that hurt you as a company usually when you pay out too much in dividends? You might have projects you have to turn away because you no longer have the cash, you paid too much in dividends. You know what Miller-Modigliani assumes? That you can raise new equity with no issuance costs. In other words, it's costless to replace equity. And if it's costless to replace equity, and that's Praga's point about why buybacks might have gone up, but in the Miller-Modigliani world, there's no cost. So if you pay too much, not a big deal. You raise equity. You're saying, wouldn't I as a shareholder be affected? Not really, because here's what will happen. When you raise equity, your price per share will drop, but you get that big dividend in your pocket, and it's easy to show that the total return you make will remain unchanged. Now, as an investor, you're saying, but I'm getting taxed at different rates. You know what Miller-Modigliani assumes? That you tax the same rate on dividends and capital gains. By making those 2 assumptions, effectively, I've removed any problems with paying up. Saying, what if I pay too little in dividends? Miller-Modigliani assumes you don't do stupid things with the cash. Like what? Take projects you shouldn't be taking. And if a company accumulates cash, cash by itself has a neutral effect on you. Let's take Apple, right? I'm a shareholder in Apple. And I'm a shareholder in Apple. I get about 1.85 billion in a smartphone company and 150 billion in T-bills. That's the way I think about my investment in Apple. It's not broken down that way, but I am a part share. So How does it play out in my portfolio? I hold less in T-bills overall because Apple holds T-bills for me. And as long as they leave it in T-bills, it doesn't hurt me. So in the Miller-Modigliani world, your investments are unaffected by your dividend policy. And since your value as a business is driven by what you invest in, your value as a company is not affected by how much you pay in dividends. There is a subset of companies out there that fall pretty close to Miller-Modigliani world. They operate in countries where there's no taxes on dividends and capital gains, and where equity issuance is really easy to do. And once you get to that point, it really doesn't matter. So you say, how much should I pay in dividends? Pick a random number. That might be too strong, but pick a number and everything will be taken care of. Let's talk about the dividends of bad school. And all I have to do to show you the dividends of bad school is show you the rates at which dividends have been taxed at. That's the purple line. And the rates at which capital gains have been taxed at. It's no brainer, right? Until you get to 2003, almost every single year, dividends are taxed at a much higher rate than capital gains. So the school of thought says, why are you paying dividends? Your shareholders are going to be hurt. Now, it depends on your shareholders, right? Because these are the highest marginal tax rates. And we know tax brackets change. So if you're an individual who receives very little income, you might have only a 15% or pay no taxes at all, right? You're 75 years old, you're collecting Social Security, you get some dividends, you might not have any taxes at all. So to address the question of whether this applies in your company, you have to know who the shareholders in your company are. What marginal tax rate do they face? You could always send a survey question to every shareholder saying, can you tell me what tax rates you pay? Odds are nobody's going to answer you. That's too much of an invasion of privacy. But there is a way in which you can back out from the market what your investors at least collectively pay in taxes. You're familiar with an ex-dividend day is, right? In fact, that's the day the old Wall Street Journal, there'll be an X next to your stock. That's the day by which you have to buy a stock. The old days, companies would declare dividends, and 4 weeks later, there'd be an ex-dividend day. And that day, they would close the books, they would record who the shareholders were. It's all done digitally now, and the checks would be mailed out to those shareholders. It's a big day in terms of transferring ownership to the dividend. Let's suppose you have a stock, and the stock price, you bought, let's say we're all shareholders in a company. We bought the shares 5 years ago for a price. Any price, $8, $10. Tomorrow is going to be an ex-dividend day. And we're faced with the choice of whether we want to sell before the ex-dividend day, in which case you lose the dividend, or sell after. You're saying, why would I ever sell before? Because the price, if you sell after, will be lower, and you got to decide which one is better for whether you want to collect the price and not get the dividends, the higher price, or go with the lower price and collect the dividends. Let's say for every one of us, selling the stock earlier is going to give us a higher cash flow. What's going to happen? We're all going to sell at the same time. The market's going to implode, right? The price is going to drop. If for every one of us, selling after gives a higher cash flow, nobody will trade. So for this market to be in any sense of steady state, on that ex-dividend day, that for at least the marginal investor, the investors who trade, who are going to stay in the company, the cash flows have to be equal. So here's what the cash flows look like. If you sell before, you get the price before and you pay capital gains taxes and you're done. There's no dividends. If you sell after, you get lower price, you have capital gains taxes, and you get the dividends on which you pay whatever the dividend tax rate is. To keep this market in steady state, those two cash flows have to be equal for the typical investor in the company. Not for all of them, but for the typical investor. You work out the algebra, and it's kind of, on the ex-dividend day, what you're going to get is the drop in the stock price relative to the dividend. When we start class on Wednesday, we're going to look at how that can be used to reverse engineer what the tax rates you face as an investor are. So by looking at ex-dividend days. So if you get a chance between now and Wednesday, see if you can find a stock that goes ex-dividend and look to see what happens on that ex-dividend day.
We said, oh, like the return on invested capital minus G ratio of WACC minus G.
Yeah.
We said like the WACC represents risk, G is growth, what did you say that the return on invested capital, that's in essence value?
If the ROIC is equal to the cost of capital.
It was more of like you were breaking down the equation, you were like, oh, like this, perpetual value equation is just a restatement of that. Right?
Oh, yeah, it's basically a free cash flow to the firm divided by cost of capital minus the
Yeah,
growth rate.
but you're
So
saying
start
the
with
book value times ROIC
Right.
is.
Yeah, exactly. You break it out, you do the algebra, you end up with that simplified.
I try to simplify it back, how you can remember.
Yeah, you can always, so go back to the original equation, rewrite the free cash flow of the firm as EBIT times one minus C
Yeah.
times one minus GO over ROIC, right?
Yeah.
And then work it through, you'll end up with this ROIC minus C. Takes a little algebra to get to the bottom.
I went through all your stuff.
Yeah.
The first algebra. And the last question was about, I forgot to ask you. It was one when we were doing you did like a present value of the terminal value, and then you remove the terminal value.
Yeah.
One of the slides. That's just because, I think it was the coupon, something.